Okay, so here's what happened. Canadian inflation came in at 3% year over year in July, up from 2.8% in June, and a touch above what economists were actually expecting. And you're probably thinking, great, inflation's heating up again. Here we go. But hold on, because almost the entire move is explained by one single thing, and that's gasoline. Gas prices were up 25.7% year over year, largely because of the conflict in the Middle East, mostly because disruptions around the Strait of Hormuz and the Red Sea shipping routes. Now, you may have heard this before. If you strip gasoline out of the number entirely, the inflation metric, inflation has held steady at 2.2% for the past 3 months running. But here we are declaring that we've reached 3% from July's reporting. So, what that tells us is that it's not a broad based inflation problem. It's clearly a geopolitical problem. So, if not for the Strait of Hormuz conflict, we would be sitting pretty good right now, closer to the more desirable 2% rate of inflation. And here's how fragile that what they keep referring to as a temporary shock really is. Whenever the Strait of Hormuz actually reopens briefly, oil prices drop and market driven rates ease right along with it. And then within days, the conflict flares right back up and everything essentially rises again. This on again, off again pattern makes temporary like a real shaky word to lean on. So now let's move over to the Bank of Canada. They thankfully don't obsess over the headline number the way the news coverage does. They instead watch for what are called core inflation measures, which, like we talked about before, strip out the most volatile stuff like gas, the big one, and the next big one, food. And then they analyze these measures to get a better idea of what's really going on. And with these volatile elements stripped out, they are concluding that the core metrics came in at just under 2%, basically putting them right on target. And that's exactly why most bank economists expect the Bank of Canada to stay put at its next meeting, which is on September the 2nd, and likely for the rest of 2026. So then the rest of the market herd tends to relax as well. So not much action expected for the consumer prime rate of 4.45%. Expect it to remain that way for the remainder of 2026. So that's the good news part of where we are at. Let's now look at the other more alarming parts that we need to be aware of. First, regular core inflation, the monthly version, just posted 3 straight months of gains. Okay, so this is not stripping anything out. Okay. Second, the oil supply story really hasn't resolved. The U.S. energy forecasters aren't expecting some of the affected producers to get back to pre-conflict output until sometime next year. And energy stops adding to inflation only once prices are flat or lower than a year ago. And that could realistically be sometime in 2027, hopefully. Third, copper is sitting near an all-time high. And copper tends to move early with the broader business cycle. So this tells us that demand isn't cooling off the way this whole temporary shock narrative would suggest. And lastly, Canada's own economy is actually picking up steam as well. The unemployment rate just fell to a 2-year low, and second quarter GDP growth was revised up to 3.4% annualized, higher than the Bank of Canada's own estimate. And then you factor in global AI investment. This is a big one that's projected to triple over the next couple of years. And now you've got some real growth momentum sitting underneath all of this that we've just talked about. And you're probably thinking a stronger economy, that's good. Well, yes, but it's also exactly the kind of thing that triggers a central bank to actually hike interest rates. And of course, I'm referring to prime rate, which affects all mortgages and loans that are linked to it, namely the variable rate mortgages. So these are some cautionary notes to be aware of as we enter 2027. No need to panic, but just be aware and ready to shift or potentially experience a mild degree of volatility to start the new year. That's really if you're in the variable rate vehicle. Okay, so that's the outlook for variable rate mortgages. What about fixed rates? So if the outlook for prime rate is to remain flat for the remainder of 2026, could the same be said for the fixed rates? Not necessarily, and here's why. The Bank of Canada controls short-term rates, and that's what moves your variable rate mortgage. But fixed mortgage rates aren't priced off the Bank of Canada at all. They're priced off bond yields. And bond yields globally have been volatile lately. Sometime last week, the yield on the US 30-year Treasury bond topped 5.3% for the first time since right before the 2008 financial crisis. Japan's 30-year yield broke above 4% of the first time in its 27-year trading history. UK government bonds hit their highest yield since 1998. You see the pattern here? And here's the correlation to be aware of. When bond yields rise, so too do mortgage rates. These rising long-term yields have already pushed mortgage rates higher in the UK, Europe, and Japan. So why is this happening? Part of it is inflation expectations for sure. But there are two other forces at play that have nothing to do with inflation at all. And one is government budget deficits, which basically keep growing and really never go away. The other is AI, specifically the enormous amount of corporate debt that AI companies are issuing to fund their data centers around the world and the infrastructure. That debt competes directly with government bonds for the same pool of investor money. And when there's a new and aggressive competitor for capital, bonds sometimes have to offer a better yield to still attract buyers. And that's what's going on here. So if government bonds are increasing their yields to compete and attract these investors, that effectively influences higher mortgage rates. So here's the takeaway from this episode. The Bank of Canada holding its rates steady does not mean your fixed rate is guaranteed to hold steady too. Those are two completely different rates driven by two completely different forces. And right now, one of those forces is under real pressure globally, and that's the fixed rates. Canada's fiscal situation isn't nearly as strained as the United States is, but of course, we're not on an island here either, as everyone is aware. Whether we like it or not, we are intertwined and almost solely influenced by the U.S. markets and their economy. Even with the Bank of Canada sitting still, Canada can't fully sidestep this upward pressure. If and when the U.S. reacts, as it will, Canada will ultimately do so as well, to a relative degree, of course. And now let's tiptoe into the housing market and talk about what is happening there in relation to all the market dynamics currently in play. Home sales rose 0.5% month over month in July. So that's the fourth straight monthly gain. New listings fell 1.6%. That's the third drop in a row. Put those two together and sales to new listings ratios tightened to 51.3%, which is closing in on the long-term average of 54.7%. So anything roughly between 45 and 65% is considered a balanced market. So nationally, we're sitting comfortably inside that range right now. But let's peel the onion here. Markets that were red hot sellers markets over the past year, like the Prairies, Quebec, and parts of the East Coast, have been steadily cooling toward balance. And markets that were leaning towards buyer's territory, like mainly BC's lower mainland and Ontario's greater Golden Horseshoe, have also shifted into balanced conditions. So everybody's kind of meeting in the middle right now. There were about 205,000 properties listed for sale across Canada at the end of July, and inventory sits at 4.7 months nationally. The lowest point so far this year, just a touch below the long-term average of 5 months. And for context, anything below roughly 3.6 months is considered a seller's market, and anything above 6.4 months leans towards buyer's market. So a few provinces, Saskatchewan, New Brunswick, and Newfoundland and Labrador, are still borderline sellers markets, but almost everywhere else has drifted back toward the long-term average, including Ontario, which was in outright buyer's market territory for the first 4 months of 2026. And here's another noteworthy metric. The National Home Price Index ticked up 0.1% in July. That doesn't sound like much, but it's the first monthly increase since November 2024. Basically, the first metric bump in prices in almost 2 years. Prices are still down 3.3% compared to a year ago, but that annual decline has been shrinking every month since January. And July's reading was the smallest year-over-year drop since October 2025. What that means practically, if you've been sitting on the sidelines hoping for a raging buyer's market in Ontario or BC, or waiting for prices to keep sliding, that window appears to be closing, as it's looking like those markets are normalizing. And if you're in the prairies, Quebec, or Atlantic Canada, conditions have actually gotten more balanced and more buyer friendly than they were a year ago. Okay, so from a mortgage rate perspective, here's what this means. If you're on a variable rate right now, don't build your budget around the assumption that cuts are coming soon. Build in some cushion instead. Ask your broker how much your payment would increase to if rates climbed by 50 to 75 basis points. So that's 0.5 to 0.75%. And if you're comfortable with that, then carry on. If you've got a renewal coming up in the next year, plan for more than one scenario. Explore medium to longer term fixed rates, but also look at the prevailing variable rate story, as it's somewhat easier to predict as well. And if you're shopping for a fixed rate or thinking about buying, this is the part where the bond yield story actually matters to you directly. Waiting around for fixed rates to drop further is a bet against the global bond market that's currently moving the other way. And if you've also been waiting for home prices to fall further in a market that's already rebalancing at the moment, that particular window is starting to narrow as well. And one more thing, rent inflation slowed to its weakest pace since 2021. And grocery price growth cooled as well, even though it's still outpricing overall inflation for an 18th straight month here. I know it's not huge, but these are wins. Small ones, yes, but indeed they are wins. So here's the bottom line. Inflation looks hot on the surface almost entirely because of gas prices tied to a conflict that keeps flaring back up. And the number the Bank of Canada actually prioritizes is sitting close to that target, with the decision expected September the 2nd. Housing is quietly rebalancing across the country, which is genuinely good news if you've been waiting for a fair market. But it also means that the extreme buyers conditions in places like Ontario and BC aren't going to last forever. And underneath all of that, a global bond market story driven by AI-related borrowing and government deficits, not Canadian inflation, means at the moment, fixed mortgage rates carry a degree of upside risk that has nothing to do with the Bank of Canada decides next. Okay, so going forward, stay light on your feet, stay informed, and make the decision that feels best for you. Okay, I hope you found this episode helpful. That's all I got for you today. Call or text me anytime to discuss this episode or others in greater detail, especially if you're in British Columbia or Alberta, as I am licensed to service these specific provinces. Call or text me at 604 800 9593, or you can get me on WhatsApp, or just go ahead and link up to my website, homefinancingsolutions.ca, where you'll find my complete catalog of past blogs and podcast episodes. And one more thing, check out my award-winning mortgage app. It's embedded somewhere in the notes or profile section from where you're listening to or viewing this. This thing is amazing. It comes equipped with tons of calculators, market interest rates, and every other thing you can imagine. It even enables you to do a snap pre-qualification on yourself. You got to check it out. Give it a try. Thank you again for tuning into Mortgagenomics Canada. Stay well, everyone. Talk again soon.